Hi, my name is Lisa Rittenhouse, and today I am talking about accounting. And the topic that I chose to discuss today is to demonstrate an understanding of the accounting equation. This will be identifying what the accounting equation is. We will be talking about explaining what its purpose is and how to apply it to the accounting world, and also the ethics behind it. So I hope you enjoy this. Accounting is very important in the business world in order for them to become successful and to thrive. Accounting determines whether its revenue is greater than its expenses. That is probably the main reason for accounting. Although basic accounting is very simple, finding all areas where the company is spending and earning money is the challenging aspect of accounting. Another reason why accounting is important is for the reason that the IRS requires companies to report financial data for tax purposes. There are organizations and rules that are put in place that help govern the accounting profession. The first organization is the Financial Accounting Standards Board, and they oversee the creation and accounting standards throughout the United States. They are overseen by the Securities and Exchange Commission, and the guidelines that are put in place for accounting are called Generally Accepted Accounting Principles, otherwise known as GAAP. Economic entity assumption is an organization that stands apart from separate economic units. The entity refers to one business separate from its owners. There are 4 different types of business organizations. The first one being a sole proprietorship, a business with just one owner. A partnership is a business that is ran by 2 or more owners, but they're not organized as a corporation. A corporation is a business organized under state law that is separate legal entity. A limited liability company, LLC, is a company in which each member is only liable for his or her own actions. Going concern assumption is assuming that the business will remain in operation for the future, enabling them to giving them the ability to prepay and accrue expenses. An example of this is during the 2000s, General Motors was given a bailout by the federal government because they were getting ready to close the doors and declare bankruptcy. The government stepped in, gave them money, and they were able to get through that difficult time and keep their business going and still remain in business yet today. Accounting equation is the basic tool of accounting measuring the resources of the business, so what the business owns or has control of, and the claims to those resources, like what the business owes to creditors and to the owners. The equation is very simple. It's assets equals liabilities plus equity. An important understanding of the equation is that whatever the number is for assets, it always has to equal the left side, or the right side, which is liabilities plus equity. So the left side always has to equal the right side. In order to better understand the equation, it's best to know what exactly assets is, what liabilities is, and what equity means. Assets are something of value that the business owns or has control of, such as cash, merchandise, inventory, furniture, and land. Liabilities are debts, for example, accounts payable. So anything with the word payable, it usually means liability. So accounts payable, notes payable, salaries payable, or loaned money. Equity is the amount of assets that are left over after a company has paid its liabilities, which demonstrates the company's net worth. Equation is what is account payable? Account payable is a short-term liability that will be paid in the future. So account payable would be a liability. Account receivable is the right to receive cash in the future from customers for goods sold or for services performed. How to identify whether an account is an asset, a liability, or equity. Here are some examples. Assets would be accounts receivable, vehicles, cash, supplies, building, land, and equipment. That is what the owner owns. Liabilities is something that they need to pay out, which would be accounts payable, notes or loans payable, um, salaries payable, interest payable, or unearned revenue can be considered a liability. Equity is land, common stock, preferred stock, retained earnings, current year's net income, interest revenue, and owner's capital, anything that the owners contribute to the business. The other two items that are very important to accountants are chart of accounts and ledgers. Chart of accounts is a list of all the company's accounts with their account numbers listed. A ledger is a record holding all the accounts of a business, the changes in those accounts, and their balances. Chart accounts and a ledger are similar in that they both list the account names and account numbers of the business. The ledger does go into a little bit more detail, providing information such as the increases and decreases of each account for the specific time period and the balance of each account. All heard about transactions, but the definition of a transaction is an event that affects the financial position of the business and how it can be measured with faithful representation. How transactions affects the accounting equation is there are 3 steps. Transaction steps: owner's contribution, and cash in the equity. Step 1 is to identify the accounts and the account types. Step 2 is to decide if each account increases or decreases. And step 3 is determining if the accounting equation is the balance. Left side of the equation must always equal the right side of the equation. So if you have $50,000 in assets and no liabilities, then the equity is $50,000. They both have to equal one another. 2 items to discuss are balance sheets and statement of cash flow. Balance sheet reports on the assets, the liabilities, and the owner's equity of the business of a specific date. Accounts payables, which are liabilities, are only reported on the balance sheet. The balance sheet reports the overall success of the business by reviewing the balance sheet. Statement of cash flow reports on a business's cash receipts and cash payments for a specific period. Only cash is reported on the statement of cash flow. The reports show that the net increase and decrease, which then reflects the final cash balance. Statement of cash flow is divided into 3 sections, which are operating, investment, and financing. So businesses rely very heavily on a high standard of accounting ethics, because if the accountants aren't honest and straightforward and accurate with their reporting, then their records can't be trusted. The example that I found was a president asking an accountant to lie on their records showing that they did meet a 15% increase from last year, instead of coming in around 13%. He asked them to move a job that was going to take place and be finalized in the next year into the current year. This is an unethical procedure, and basically is not right for the president to ask the employee to lie on the records. So the accountant needs to be upfront and honest with the president and telling him that he's not comfortable with frauding records, and he didn't want to lose his job, but he's also going to adhere to his integrity and his trustworthiness